Look, to open it up, look, I've got an ad on all four major banks. One of the key reasons for that, so basically I'm positive on the sector, and one of the key reasons for that is I think that the regulatory risk is overdone. My base case remains one of no cuts to nominal dividends and no outright capital raisings. I know some have been worried by the customer remediation provisions that have been coming out, but they haven't been troubling me. And although I see the risk of further provisions, I don't expect the magnitude of those hits to be such that they will lead to nominal dividend cuts or outright capital raisings. Now, what would happen is if the magnitudes get towards the high end of what I'm expecting, then what would probably happen is some of the banks would run discounted DRPs. And just to tell you how that works, for every 10% take up of a DRP, the banks can generally add between $250 and $400 million to their capital position. So you would have seen from my note on NAB out last week, I'm now expecting one of NAB's DRPs next year to be discounted. So generally, if it's an undiscounted DRP, they get a 10% take up. If it's a 1.5% discount that's applied to the DRP, the take up can be anywhere between 30 and 35%. So I'm expecting all four major banks to be able to hit APRA's 10.5% set one benchmark by 1st of Jan 2020 without needing to cut their nominal dividends or outright capital raisings. That's even in the case of ANZ. I mean, a lot of you would be aware that with ANZ, my view is that the capital raising cartel case can possibly result in a hit of $1 billion plus to ANZ. But even then, what they would do is they would detract from their potential buyback. And even then, I think ANZ's dividend is safe and they won't need to raise capital. The order of preference of the major banks, Westpac remains the preferred, followed by NAB, CBA. ANZ is the least preferred. I suppose one of the other things I'll just quickly say on the majors is that amidst a lot of the focus on all of the misconduct issues coming out of the Royal Commission, I think one of the emerging medium-term positive themes that's being lost is the potential for cost out. So even with a subdued, even if revenue growth remains, even if the environment for revenue growth remains subdued over the next 3 to 5 years, I think there's a lot. I'm seeing a lot of potential for the major banks to reduce their cost levels and potentially actually reduce their cost bases in absolute terms. One of the things that has really changed here is, and I'm sure a lot of you will agree with me on this, is that until 5 years ago, it was very difficult for a major bank to say that they will be meaningfully cutting their headcount because there would be a massive backlash from the unions and even from the government. It was even very difficult until, let's say, 5 years ago to be offshoring jobs. I still remember when ANZ was trying to offshore jobs to India. They were creating an IT campus in Bangalore, and even then it was very difficult for them to offshore jobs to India. But now there's a general realization that we are in the fintech age. The way going forward for the banks is increased digitization. They do have threat from emerging tech players to deal with. So I think there's a general realization now that reducing headcount and streamlining costs and directing more of the investment spend towards digitization is the way forward. And I think as that happens, the banks will be able to reduce their headcount, strip out costs from other areas as well, and improve this customer service proposition at the same time. One of the other factors, obviously, that's been weighing on the banks from a macro perspective is the rise we're seeing in bond yields. And obviously, if bond yields continue to go up, then you can expect the cost of equity capital that's being factored into Aussie banks to possibly continue to rise. That cost of equity capital right now is sitting at a pretty high level. So you've heard me say this before, but generally the cost of equity capital that I need to factor in to get to current share prices varies between 9 to 11%. And right now it's sitting close to that 11% range. Now, if bond yields keep going up, that can still rise. But the way I'm seeing the macro is that I'm seeing the rise, the extent of the rise in bond yields at the moment is unsustainable. It's creating increased risk in the increased stress in the emerging markets. And I think very soon the rise in the 30-year bond yield will start to show signs of stress in the US housing sector because enough US mortgages are 30-year fixed rate mortgages that are priced off the 30-year bond yield. Also, just very quickly on CYB, look, the share price has been under pressure recently. I think it's partly Brexit related, which is why we've seen the sell-off across all of the UK banks. But in CYB's case, I think one of the other reasons is that at least one global house has switched their coverage from their Aussie analyst to their UK analyst. I've also been told, but I'm yet to confirm, that a couple of other Australian houses or Australian coverage analysts have seized coverage. So it looks like what's happening is that the coverage composition is increasingly shifting towards the UK. And I think many of you would be aware that UK analysts are generally more bearish on the stock than Aussie analysts. So as that coverage is switching over towards the UK banks, particularly now that they've acquired Virgin Money, more UK analysts are keen to cover the stock. It's been weighing on the share price. Now look, I've got an ad recommendation on CYB. My view switched to positive when the Virgin Money transaction was announced, and that's really why I've gone to a positive stance. The other thing I'll say is, although the IRB accreditation on the mortgage side that came through was pleasing, it was expected. The positive surprise really there was the timing of the SME accreditation that's come through far earlier than expected, but the magnitude of the capital release there for me was disappointing. And what we'll see is that once the unsecured retail book gets accredited, there will actually be an increased capital requirement for the unsecured retail book once they get the IRB accreditation, and that increased requirement will likely offset the SME benefit, such that all they're left with is the mortgage capital relief.